started off the month in a bit of a tech sell-off. Foreign equities for U.S. investors had negative returns. Pretty tough month for a diversified portfolio.
The MAGA F stocks still on a year-to-date basis significantly outperforming virtually every other stock. We just finished the month of September. It was quite a month. First month we saw a lot of down movement and some reversals and some trends. Let's, for the viewers, take a look at what happened during the month of September and take us through the numbers and then the headlines of what sort of drove these numbers.
Within the context of a diversified portfolio, September was really the roughest month since March for a lot of investors. So you started off the month in a bit of a tech sell-off. Some of the most loved, best performing areas of the US equity market selling off, some quite considerably to start off the month. For no real fundamental reason, it appeared more technical. You also had a bit of a sell-off in foreign equities and a bit of a resurgence in dollar strength. So foreign equities for US investors had negative returns. And then the Fed also announced a subtle shift in how they think about their inflation targeting framework, which resulted in a slight pickup in longer-term interest rates. So many areas of the bond market also had slightly negative returns. So net for a diversified portfolio, a pretty tough month.
But not unexpected in terms of where we had come from previously and how we had been setting all-time highs. So in particular, what happened in the bond market that's worth discussing?
Yeah, the big news in the bond market didn't really happen at the short end. It happened with long-term rates, and the big news was the Fed came out and suggested that they're going to be much more tolerant of overshoots to their inflation target than they had been previously. So if you look at how the Fed manages interest rates, one of the things they look at is they're looking for price stability. So they want to keep prices or inflation near their 2% target. And they've failed to do that. They've consistently undershot that target. And you could argue that they were worried too much about inflation in 2018 and raised rates too quickly, and that may have made the pullback in late 2018 and even some of this COVID pullback more severe than it had to be, and some of the carnage in the labor market more severe than it had to be. So changing their reaction function to allow inflation to go above 2% potentially before they even think about hiking rates. You know, they're not even thinking about hiking rates at this point. So in terms of the near term, this doesn't mean a whole lot. There is no inflation. They're not going to be hiking rates for a very long time. But if you think about expectations in the very long end of the bond market, where you're having to build in long-term inflation expectations, you did see interest rates rise a little bit as investors out there started to factor in, hey, eventually, if there is inflation from everything that happened here that we've done through COVID, all the fiscal and monetary stimulus, the Fed will be less ready to hike rates, and it could actually result in rising bond yields.
And what's the definition of insanity? Isn't it continuing to do things and expecting a different result?
That's exactly right. I mean, yeah. Just because they say they're willing to tolerate inflation above 2% doesn't mean they can do anything about it or can make it happen. I can announce right here that I want to play for the Chicago Bulls. It's not going to happen.
They need you.
Yeah.
Well, great. So let's switch to the equity markets and look at the S&P and the technicals there and where we sit.
Yeah, if you take a look at the S&P 500 technicals, the first thing you'll note is we came into the month of September at new all-time highs. And with the rally from the market bottom being 58% till that new all-time high, and very quickly gave back a lot of that ground. So within the first week to 10 trading days or so of the month, you saw a lot of the early winners, the winners year to date in the stock market, and a lot of the big tech names sell off very significantly, some of them not for fundamental reasons at all. And then you saw a name like Tesla be down 30% in the first 8 days of the month because they were sort of snubbed from the S&P 500 index inclusion. But that news sparked a bit of a sell-off. Those were the hardest hit areas of the market. And then from there, the market really traded in a range, started to digest, the election being right around the corner, what this means for the market as a whole and trends within the market and how impactful this election could typically be. And also the sort of stalling of high frequency economic data suggesting, the V-shaped recovery might not be so V-shaped. So really trading in a range, but, if you take a look at this chart, one thing you'll notice is the market is still very far above the 200-day moving average. So you could argue there's still a lot of froth. Will, as you suggested earlier on, the market has come a long way, so a give back makes sense, and it doesn't have to be for fundamental reasons. And also, we're even above this trading range that has been very useful since 2018, as defined by these dashed blue lines. So it's still nothing to get excited about to go run out and buying equities on these dips. There's still a potential for more of a pullback, more volatility as we head into the election.
Right, and the tale of two markets still is in place, right? We have the MAGA F stocks still on a year-to-date basis, significantly outperforming virtually every other stock. And although that changed a bit in September, it's still the trend. So take us through this chart.
You see in the most recent month, the royal blue area is the MAGA F stocks. So Microsoft, Apple, Google, Amazon, Facebook. These 5 stocks, why we comment on them so heavily is because they've totally detached from the performance of the rest of the market. And they represent about a quarter of the S&P 500 index. So that's the most top-heavy the S&P 500 has ever been in history, even more top-heavy than during the height of the tech bubble. And what you saw was during September, those five stocks in aggregate, or a simple average, were down about 9%. And that can happen, and that can be a risk for the S&P 500 index as a whole because these stocks represent such a huge portion. But that's not necessarily a risk to the market, because if you look outside of these 5 stocks, the other 495 in the S&P 500 index, and then the other 2,500 or so in the U.S. equity market in total, they've traded totally differently than these 5 stocks. You look month to date, the other stocks in the S&P 500 were only down 3%, so pretty limited. Not even a dip. You wouldn't even really call that a dip. And if you look back over the year-to-date, 1 year, 3 year, 5 year time periods, so on and so forth, you see the rest of the market has not really followed these 5 names.
What is our outlook in terms of this trend potentially reversing, and what should investors think about if they own, which a lot of investors do, a large cap index fund?
There are one, recognizing that this trend of how much these 5 stocks have outperformed the rest of the market and how significant a portion they are of the index, these are all huge, huge numbers historically. So at historical extremes, unsustainable extremes. So understand your starting point, and then understand as we get through the end of the year, there are a lot of potential meaningful catalysts that could catalyze a reversal in this trend. You think these stocks have really benefited from the stay-at-home forever COVID type environment, and so vaccine progress continues, and there's a potential that we get multiple vaccines approved for emergency use by year end. So that could definitely be a catalyst. Also, the election is a huge catalyst. If you look at the Biden proposal and the tax implications in the Biden platform, they could really disadvantage some of these large tech companies that have a lot of intangible assets overseas that pay almost no taxes on them. So that could cause a catalyst. And then the other thing to consider is you have to think about how potentially higher capital gains tax rates could affect this trend. If Biden were to win the presidency and you get a Democratic sweep, and the signal is that higher capital gains tax rates are coming, well, these are the stocks that everybody has a huge unrealized gain in, and they might be incentivized to sell now and pay less tax as opposed to waiting and pay more tax later. So there are a lot of reasons why this trend could reverse, and then understanding that it's been so extreme that it could also reverse really for no reason at all.
Which seems to be the case for a lot of things. But well, that's a great recap for the month of September, and a lot of these topics you just mentioned, we're going to dig into a little deeper in an uncapped session. So So be on the lookout for that. In the meantime, thanks, Mike, for sharing the update, and everyone have a great month of October.
Thank you.